Welcome once again to our continuing YouTube video series on taxes and the law. My name is Christopher Neufeld of Neufeld Legal. And in this particular YouTube video, we're going to be discussing capital losses in the United States context. And the reason I make that clear is the fact that every country typically has their own specific tax rules. So you have to look at the particular jurisdiction within which you are operating. So first of all, what is a capital loss? Well, it's pretty much the exact opposite of a capital gain. It is where you calculate your capital property transaction results and you result in a negative number. So what you're doing is you're taking your initial acquisition cost of that capital asset or capital property, and once it's sold, you're selling it for a loss such that the proceeds of disposition are less than the acquisition cost and the expenses and outlays required to sell that piece of property or capital asset. And when it's a negative, it's a capital loss. What you're then looking to do is you're netting capital losses against capital gains in the interest of reducing your capital gains exposure. By lessening the amount of capital gains you have, you will invariably have less taxes to pay. Nevertheless, there are general rules that we're going to be discussing, and those rules are going to be specific to the United States. So what the rules typically pertain to are where you can claim the deductions of a capital loss where it's not in the particular year that you're dealing with. So let's say you have capital losses of $25,000, you have capital gains of $15,000 in that given year. What can you do with those excess $10,000 of losses? That is our goal, to deal with that and to reduce the capital gains and tax exposure, and effectively, if it's possible, go back years and mitigate the taxes that were paid in previous years and effectively get a refund. So, what are the rules in the United States particular to this? Well, a capital loss can be carried to other years in the following order. First, 3 years prior to the loss year. Second, 2 years prior to the loss year. Third, 1 year prior to the loss year. And fourth, any loss remaining can be carried forward for a further 5 years. And when you're carrying a net capital loss to another tax year, you treat it as a short-term loss. It doesn't retain its original identity as long-term or short-term. Now let's take a look at a straightforward example that will help us understand this whole concept of carrybacks and carry forwards with respect to capital losses. So let's presume we have, in a given calendar year, our subject corporation had a net short-term capital gain of $5,000 and a net long-term capital loss of $15,000. What we would then do is take the short-term capital gain will be offset by some of the long-term loss, leaving a net capital loss of $10,000. Now the corporation is then going to treat this $10,000 as a short-term loss when it is either carried back or forward. So taking this corporation's $10,000 of short-term loss, we look to carry it back 3 years. So let's presume that in going back 3 years, there was no capital gains to offset against, and the same with the second year. But in the most prior year, that there was losses, capital losses, or capital gains, I should say. So the corporation had a net short-term capital gain in that year of $12,000 and a net long-term capital gain of $7,000 in that particular year. What would be then done is you would subtract the $10,000 of short-term loss first as against the net short-term gain. And this will result in a net capital gain for that particular year of $9,000. And that $9,000 gain, as opposed to the pre-existing claimed $19,000 gain, would consist of a net short-term capital gain of $2,000 based on $12,000 minus $10,000, and a net long-term capital gain of $7,000. As you can see, it's ascribed first to the short-term capital gain. Now, a particular point of note is that you got to consider that this is not necessarily applicable to S corporations. So a corporation may not carry a capital loss from or to a year for which it is an S corporation. So you got to be cognizant of that. Also cognizant of it early on with your planning of the corporate structure and your business model. Because if you're going to be incurring, or you anticipate incurring capital losses, and you want to transpose them between years, it may be preferable to use another corporate entity form than an S corporation. Naturally, this is something you want to be discussing with a knowledgeable tax professional. So we go back. What are our general rules for carryover and carryback of capital losses? Well, the general rules that we're going to look at is that when you carry a capital loss from one particular year to another year, you look to the following. When you're figuring the current year's net capital loss, you are not permitted to combine it with a capital loss carried from another year. In other words, you can carry capital losses only to years that would otherwise have a total, remember this, a total net capital gain. Next, if you carry capital losses from 2 or more years to the same year, which is permissible, what you should be doing is deducting the loss from the earliest year first. Because if you're not doing that, you're setting yourself for the chance that you might lose the opportunity to use that capital loss in a subsequent year. Hence, you try to use the earliest because they do run out. And finally, you cannot use a capital loss carried from another year to produce or increase a net operating loss in the year to which you carry it back. This is what sometimes people might try to achieve, but the idea is you're taking capital losses to offset capital gains, and you're not doing any further crazy manipulation. With that being said, these are just the general rules, and there are a lot more specific tactical strategies that you can employ relative to capital losses and capital gains. But that is all particularized, depends largely on the transactions, your business strategies, what the underlying business is, and it's something that is fact-specific, fact-driven, and always needs to accord with the Internal Revenue Code and what the position of the Internal Revenue Service and Department of Treasury are putting out there and take the position of. So for that purpose, you really should be consulting with knowledgeable tax professionals to assist you in doing this work correctly and optimizing the results from your tax planning and tax implementation. We trust you found this YouTube video informative and hope it gives you some direction and guidance to build upon while working with your tax professionals, working with the Internal Revenue Code and what the IRS has put out there as the guidance to correctly and appropriately deal with capital losses. Thank you.